Okay, well, I think we'll get started. So welcome again. This session today is the fourth session of our Simple Steps series, and it focuses on financials. And we are very fortunate to have a financial expert with us, Richard Brooks, who will be doing the presentation. Before we get started, I would just mention to you that you will be getting a copy of the recording. If you have questions, please put them in the chat or in the Q&A. Either one, we will be monitoring them and hopefully be able to answer your questions. So I'm going to turn it over to Richard and we'll get started. So Richard, it's yours.
Thank you, Anita, and welcome everybody. Thank you for signing up to participate in this webinar. Before we get into it, I just want to review a couple of very, very short slides about SCORE for those of you that may not be familiar with SCORE. This is an image of our current website. We serve Northeast Ohio. You can see the 8 counties that we serve here on the screen. We were the 2022 National Chapter of the Year and the 2024 Ohio District Chapter of the Year. The SCORE Cleveland chapter is generally considered one of the top 10 in the country. We're very proud of that. And we have a cadre of just excellent mentors that can cover an awful lot of business for people in our area. To find a mentor, if you don't have a SCORE mentor at this point, see in the lower left of the screen there, it says request a local mentor or browse mentor profiles. You can actually pick the mentor that you want. Or if you don't want to take the time of doing that, you can just click the request a local mentor, and based on what you tell us you need, we will fit a mentor to help you. All of our mentoring is free. We have a number of chapters around the country, and if we don't have the expertise within our chapter, we will help you find somebody within SCORE that can help you. All of our workshops are free. And as Anita mentioned to you a few moments ago, you will get a copy of the recording of this workshop. We also do roundtables and we do advisory committees. We don't do boards of directors because those tend to be compensatory, and we do not accept compensation for any of the work that we do for you. So we do an advisory board. So let's talk about what we're going to get into today, and this is financial management for your business. Please understand in advance that I'm going to go through a lot of things really fast. It is like drinking from a fire hose, but there will be time to answer questions, and your SCORE mentor can fill in blanks if for any reason I'm not able to get to the questions, all the questions today. So the first thing we're going to do is talk about the importance of financial planning. And then we're going to talk about the difference between financial and managerial accounting, and that's really important. Then we're going to talk about the 3 most important financial statements, and I'm actually going to show you some simple examples of what those look like and how to use them, which is really important. We're going to talk about fixed operating expenses, what makes up fixed operating expenses, forecasting sales and units and prices, and then understanding the financial information that you have within those financial statements and some diagnostic metrics. Okay, let's talk about financial planning and goal setting. Why do we do this? Well, we want to match your income goals with the financial plan to achieve them. And that's really important. One of the questions that I ask all my clients when we first got together is, what are your personal goals? Are you doing this to make a lot of money? Are you doing this because you're tired of working for somebody else? Are you doing this because you see a need in the market and you want to fill it, what are your personal goals? And almost everybody, one way or another, has some financial goals that tie into developing a business. And so you need a financial plan to help you get where you're going. I tell my clients it's like following the yellow brick road from The Wizard of Oz. I'm going to help them find the yellow brick road and follow the yellow brick road. But it's going to be up to them, the development of the plan, which is the yellow brick road, to actually get to where they want to go. It will also help you gain a better understanding of the financial risks and rewards for your business, identify early development and startup costs, ongoing operations, expenses, and funds you need to finance the business. The number one reason why new businesses fail, is they are underfunded. And so that's really important to remember. And finally, have a plan to help you guide the business in the decisions that you have to make. These plans are ongoing. They are not a one-time thing that you just develop to show to a lender, or you develop to show to a partner or some investors, and then you put it in a desk drawer. These plans should be updated as your business grows. Remember, businesses don't plan to fail. They often fail to plan. Next, okay, financial versus managerial accounting. Financial accounting is the process of recording, summarizing, and reporting a company's business transactions through financial statements. It is a historical look at business finances. So you're really looking backwards. What did I do last month? What did my business do last quarter? What did my business do last year? This is really important because it can help you identify trends and issues that you would have to address looking forward. Managerial accounting is the process of using the accounting information from the financial accounting, from revenues to production inputs, outputs affecting the supply chain internally in support of your organization-wide efficiency. Basically, what we're saying here is that managerial accounting is your using of the historical information to forecast the future. And that is the difference between the two, and it's very, very important. We're actually going to focus today more on managerial accounting than we are on financial accounting. But as you start your business, as your business grows, you're going to use financial accounting to record what you've actually done and then compare it to the forecast, the plan that you've developed. Okay, the financial planning process. Clearly write out your business and personal goals. And you need two levels of goals here. You need personal goals. What do I plan to get out of this business? And what are goals for my business? And I generally recommend to my clients that for the first year, we focus on 3 goals. And they can be any 3 that are relevant to the business. Just to say, I want to make a lot of money is not a financial goal or a good business goal. And we're actually going to talk about that in a little while. Then you're going to draft a business plan that achieves those goals. This is your yellow brick road. Create a financial model that supports the plan. Usually part of the plan is at the end to actually show the finances of the business, what you project the business to be. And again, this can be if you have an existing business or if you're just starting a business. So the financial plan and the business plan are really essential for all phases of the business. Test the plan in the financial model to make sure that you can actually achieve what you're going to do. Revise the goals and plan as necessary. If for some reason through your plan you aren't able to achieve all your goals for the coming year or the coming period that you're looking at, a lot of startup goals are for 3 years, not just one. So if you're not able to, focus on what you can do, and maybe make a decision along the way that maybe this business isn't going to get me where I really want it to go. Finally, revise the financial model as necessary, and then finalize all your goals to get to where you need to go. And at that point, you are ready to actually show this to investors, to show this to lenders, to show this to partners, to get the business going. Okay, goal setting. We recommend that you use SMART goals. Okay, and SMART is an acronym. It should be specific. It accurately describes what you want to achieve. It should be measurable. There are clear metrics involved in your SMART goal. Achievable. Is it realistic? And maybe a little bit of a stretch. That's perfectly all right. Most of the businesses that I've been involved in, and I've opened over 20 businesses and been involved in more than 20 businesses over my career, we usually set a little bit of a stretch. Not 50% more than we knew that we could do, but maybe 10% more that we could do. So make sure that they're achievable, relevant. Is the goal specific to the business? And then finally, time bound. There should be a time limit to the goal. And so I wrote a good example here. By the end of year one, my business will have at least $50,000 in revenue, $10,000 in net profit, and have a customer satisfaction rating of 9 out of 10. That is a specific goal in all the criteria that we have here. It is specific: 50,000 revenue, 10,000 in net profit, 9 out of 10 customer satisfaction rating, measurable. Did I achieve 50,000? Yeah. I know where I am because I knew what I was setting up to do. Is it achievable? Well, that may be somewhat subjective at the time that you create the goal, but then you can measure it, again, measurable, against what you actually achieve. Is it relevant? Well, 50,000 in revenue, 10,000 in net profit, and 9 out of 10 in customer satisfaction. That's pretty relevant to the success of a business. And then time bound, by the end of year one. Okay, so that could be an example of one goal. You might also have by the end of year one, I should have 3 additional people employed in my company. They're trained and they're fully trained and they're ready to go in my company. That might be a goal. Another goal would be to have 5,000 followers on your social media sites. So those are examples of different kinds of goals that you can set up for your business. Excuse me. And this applies not only for businesses that are just starting up, but also businesses that are in existence. Okay, we're going to get into 3 financial statements. Financial statements show the financial status of the business for a defined period of time. You use these financial statements. These are the financial statements that we talked about in financial accounting to help you do your forecasting, which is your managerial accounting. So we're going to talk about 3 different ones. The first one we're going to talk about is the income statement, and it shows the company's income and expenditures. It also shows whether the company is making a profit or a loss for a given period. Then we're going to talk about the cash flow statement. The cash flow statement summarizes the amount of cash flowing into and out of your business. This includes all cash inflows a company receives from its ongoing operation and external investment sources. And then we're going to talk about the balance sheet. And we're not going to spend a lot of time on the balance sheet, but we are going to show some very, very simple example of the balance sheet. And it contains summary information of the company's assets, liabilities, and owner's equity at a specific point in time. These are used for both financial and managerial accounting. And if you are doing some lending, or if you have outside investors, they are likely to request copies of all these three financial statements over a period of time, as long as your loan or their investment is active with your company, because they want to know how well the company is doing. And in most cases, they're not going to just take your word for it. They're going to want to see some accurate financial statements. So you need to be aware of that. Not only that, but these three statements are critical to you understanding your business. A couple of the clients I have right now, when I ask them, how much money did you make last month? And they don't know, that tells me that they haven't really spent time in their income statement. I ask them how much money they have in their checking account. If they don't know, that tells me that they haven't really spent as much time as they should on their cash flow statement. So these are really important, not necessarily on a day-to-day basis, but certainly on a month-end basis, if not before. Okay, the income statement. It shows you the company's income and expenditures. It also shows whether the company is making a profit or a loss for a given period. So what we're going to do now is I'm going to stop sharing, and then I'm going to start resharing. Anita, can you see this?
Yes.
Okay, very good. I'm going to blow it up just a little bit. Okay? And this is a very, very simple example of an income statement. Okay, and we're using Anne's nursery, and for those of you who've been with us for the three previous sessions, Anne's nursery was part of that program. So we're going to use this as an example. So here is a simple example of an income statement. Okay, and you can see across the top it has Anne's nursery's name, and the first thing it discusses is revenue. And so Anna's decided for very simple purposes, and again, she might break this down into more detail in her actual statement, but for our purposes, we simplified it into really 6 product lines, of which one is open, just in case there's a miscellaneous for Anne. But she's selling large ornamental trees, in-ground ornamental vines, potted large ornamental shrubs, potted small ornamental shrubs, and supplies. So for the month of January, you can see she sold $11,800 worth of goods. In February, 31,000 and change. In March, 57,500. In April, 67,000 and a little bit more change. And you can see it actually goes on through the end of the year. And at year end, there's a total. She had total sales of $111. Okay. But also notice that she broke it down by category. She's showing the sales for each portion or each product that she's selling here. And then also notice that she has a percentage column, because she wants to know not only how much she sold, but what percentage of sales that product represents. And there are a lot of reasons for doing this. And I'll give you an example here. If you look at January, she sold $2,800 worth of large ornamental shrubs. and that was 23% of her sales. But notice in February, she sold 14,400, which represented 46,000, or pardon me, 46% of her sales. And then in March, it dropped down to 27 or almost 28%. And then in April, close to 28%. Okay. And then in May, it dropped to 25%. In June, 26%. But she needs to understand these fluctuations because maybe there is a reason why things took off for her on this product, the potted large ornamental shrubs, in February, and then not so much as a percentage of sales in March. So the raw numbers that you see here are important, but the percentages that you see are just as important because they show you trends of what is going on with the products and the services that you are offering. So that's the total revenue. Now let's get into the cost of goods sold. The cost of goods sold is made up of what does it cost us to actually produce this product? For those of you who are in a service business, what does it cost you to actually provide the service that your company offers? So and the percentages here are percentages of sales. So, for example, let's go back to the potted large ornamental shrubs. In January, the cost for Anne was $700, and that was 5.9% of sales. In February, the cost was $3,600, and that was 11.59% of sales. In March, $4,000, but it was only 6.96% of sales. And the reason why this is so important is you may have a great seller on top, okay? In other words, up here in revenue. She sold a lot of 14,400, which was close to 50% of her total sales. But the cost of actually producing that 14,400 compared to the rest of the a year was about double what it cost her on a monthly basis for the rest of the year. So there may be some reasons involved in this. It's good to have the sales, but if your costs are out of line, that creates a problem for you. And you can see here that her costs jumped considerably in February. So that's why the percentages are so important to you. So we have the total cost of goods sold of 8,096, which is 26.07% of sales. And that gives us our gross margin. Our gross margin is the difference between our total sales and our cost of goods sold. Okay, so the cost of goods sold would be, for example, the trees, the actual shrubs themselves, the vines themselves, the fertilizer that goes into them. That's specifically what the cost of goods sold is. Okay, so we subtract that out, and that gives us our gross margin. In the case of January, she still, on a gross margin basis, had made $8,638 or 73%. In February, she made $22,954 or almost 74%. In March, she made $42,256, 73.5%, and so forth. So her gross margins are remaining fairly consistent throughout the year. But should there be a variation, she now has the data. Notice for example, down here, toward the end of the year, she's gone from 73 to 71 and 72%. Now, that's a small percentage number, but it would still be, if there's consistency, some reason to go back and identify why the margin, even though you had the gross numbers, why the margin percentage had decreased. And then we get into additional operating expenses. So her payroll in January was 11,576. In February, 11,576. In March, 11,576. But notice what's going on here. Her payroll in January, 11,576, was almost 100% of her gross revenue in January. So she was actually working at a deficit once she paid her payroll for the month of January. Remember, I gave you a comment a few moments ago that the number one reason why businesses fail is they're underfunded. She needed to have money in the bank to pay all her bills, including her payroll. Okay, so January was not a good month for her. In February, she had a gross margin of 22,954, and half of that, 11,576, was taken up by payroll, but it was still only 32% of sales, or 37%, I'm sorry. In March, her payroll was the same, but because her income grew, it was 20.13% of sales. And you can see it continues to decrease. And then it starts to increase again because her sales go down. Notice here in the month of November, her sales are so low, her payroll is 145% of sales. And in December, her payroll is 200% of sales. So that's why it is so important to watch this. Okay, operating expenses. You can see some general operating expenses. These operating expenses are general costs that cannot be attributed to the sale of any one product. So advertising, car and truck expenses, commissions. In her case, she's paying commissions to outside salespeople. You can see we've got more classifications in here. And then she's got total operating expenses and her income before other expenses. She's in January running a $10,500 deficit. In February, she's actually made a little bit of money before other expenses. In March, she's at 18,145, which you'll notice is 61,000, or pardon me, 61. I'm having real trouble reading today. 31.56% of sales. Notice it jumps in April to 25,366, or 37.82% of sales. And I'm just going to take it all the way over here to the end of the year. And she made at before other expenses 22,226, or 5.6% of sales for the rest of the year. Okay. And then she's got some other expenses. She's got amortization of her startup expenses. The government will allow you to write off certain startup expenses as a non-cash expense. So even though you paid for it in advance, you're able to write off that expenditure. And so, and the same thing with depreciation. Depreciation normally applies to capital expenditures, such as purchasing a truck, or leasehold renovations, or buying a building, or other capital expenditures. And a capital expenditure is generally defined as something that lasts longer than a year. Okay, that isn't entirely correct for example, in restaurants, all the small kitchen supplies, usually you write those off right away. But buying a new oven or buying a new refrigerator, that would be considered a capital expense. And then she has her interest expenses on her commercial loan, the mortgage payment itself, her credit card debt, and her vehicle loans. This is what she's paying. And fortunately, she doesn't have any bad debt expense. And so we summarize the total of the other expenses. And you notice for the month of January, she had no income. Matter of fact, she had almost 12,500 in a loss. In February, she was close to break even. In March, she actually made $16,031. And so she had an income tax liability that she had to account for. In April, she made $23,000. And at the end of the year, she only made $800. And so, pardon me, at the end of the year, she had a loss of $28.23, but she still owed $800 because of the profit that she was making before that. So that's why the income statement is so important, because it shows you whether you're actually making money or not. Now I'm going to go back and I'm going to go back to our slides. Oops, needs to go up one. Okay, now we're going to talk about the cash flow statement. The cash flow statement summarizes the amount of cash flowing into and out of the company. This includes all cash inflows a company receives from its ongoing operations and external investment sources. In most cases, you're not going to have much of an external investment sources. If you have a checking account or a bank account that is interest bearing, that you can, get your, 0.5% interest or whatever it happens to be, that would be considered in the cash flow statement, because that is actually income to the company. So again, what I'm going to do now is I'm going to go back. And I'm going to show you a sample cash flow statement. Okay, in January of the year, Ann started out with a $10,000 balance in her checking account. In the year, she's in the month of January, she brought in $4,000 in total cash, and so that was 100% of sales. In February, the amount of cash went down, and if you remember, the reason why the amount of cash went down was, and we're going to actually, as we get down to the bottom here, it'll be clearer to you how we got to that $2,500. But you got to remember, she was working at an operating loss. And so she had to use money in her checking account to pay some of those bills. Okay, so in February, she started out with only $2,500. And then she had $10,557 in sales, and that in cash sales, and that amounted to 57% of her cash sales. And then she was allowing credit. So she had $7,788 in credit sales, and that's 42.45% of sales. In March, she had $19,550 in cash sales. And look at what happened in her credit sales. It went up to $20,493, but it was 51% of her total sales. In April, $22,806 in cash, $37,950 in credit card. 62% of sales, more than 62%. May, look at what happened. 68.29% of sales, 70% of sales in June, 69% in April. So she was literally her customer's credit card for those months. Okay. And just a word of advice for those of you who have heard me in my presentations previously, don't be your customer's credit card. In most of the businesses that I've run in the past, we had an expression, in God we trust, all others pay cash. Do not extend credit unless you absolutely have to extend credit to your customers. Because look at how much money she had tied up where she was extending credit to people, but she didn't have the actual cash to pay her bills. So this is a really good example in the cash flow statement of why the statement is so important. Okay. Next, what are her cash outflows? She didn't have any new fixed assets, so we weren't worried about that. She wasn't buying any additional inventory to sell, so we weren't worried about that. She was just using her startup inventory. And then she had $791 in January for her cost of goods sold. And again, this is a percentage of sales. So it's 19, almost 20%. That's $791. That's almost 20% of her $4,012 of sales in January of the year. In February, her cost of goods sold was $4,396, which is close to 23 or almost 24% of sales. In March, 98.83 or 24, a little bit more than 24% of sales. April, 15,859 or 26% of sales, and so forth. Okay. So then we get into operating miscellaneous operating expenses. In January, she had $7,560, which was 188% of sales. Remember, her sales in January were 4,012. In February, 9,437 or 51% of sales. In March, the number went up, but the percentage went down. In April, again, the number was good, but the percentage went down because her sales grew. And so that's really important to watch. And then payroll as a percentage of sales, you notice that it goes from 288% of sales down to 63% of sales, down to 28.91% of sales, and so forth. Okay. Now, one of the reasons why this is so important is in her business plan, Anne would have projected all these percentages. And if these percentages are out of line, then it's important for Anne to go in and look. So for example, you notice that she's pretty consistent on her labor. It might be helpful for Anne to go in and say, hey, in January, I need to go in and reduce my labor so that I'm not running 288% of sales. And then her loan payments, all the other things that are required here. If she's taking an owner's distribution instead of a salary, that needs to be in here. Any payments on her line of credit. You notice in January, she wasn't making any payments on line of credit. But in February, March, April, May, June, she was making payments on her line of credit or making payments on the interest. And then here's her total cash outflows. And the total cash outflows are sum of all the everything that she was paying for, net cash, cash flows. In January, notice she had a minus 17,000. She was actually spending 17,000 and change more than she was taking in. That accounted for a minus 431, almost 432%. In February, things improved. In March, she actually had a positive cash flow of 34.98, which was 8.73% of sales. And then look what happened in April. In April, $19,371 in positive cash flow, or 31, almost 32% of sales. In April, 22,869, or a little bit more than 35% of sales. So that's really good. So then, if you take the operating cash balance, she actually had a negative operating cash balance of 73.15 in January. But she has decided that she will always have at least $2,500 in her checking account. So if you take the $2,500 and the minus 73.15, that means that she had to borrow on her line of credit $9,815. And so she borrows $9,815 on her line of credit to give her the $2,500 that she needs. And then that's where we get the $2,500 in February. Now I want to go over here to April just really briefly. You notice that she had a very positive month in April, okay? And her ending cash balance was $2,500, or $2,500 and change. And she was actually able to start going in and paying some of her line of credit back. So what that did is that she decided not to do that because she was going to need, she decided not to pay the line of credit down a little bit because she knew that she was going to need the money farther into the future. But that $2,500 became the opening line of cash balance for May. And so you can see how this worked at the end of the year. Okay. I'm just going to come down here. She had a positive amount of money of $19,039 in her checking account. So that was good news for her at the end of the year. So that's a little bit, and again, this is a simple example. That's a little bit about the cash flow statement. Finally, the balance sheet. The balance sheet contains a summary of all the information about the company's assets, liabilities, and owner's equity at a specific point in time. Normally, you look at a balance sheet at the end of a quarter, or at the end of a half, or at the end of the year. It is not the kind of snapshot that you need on a regular basis, unless you have some very, very deep financial problems. And you notice here at the bottom, we talked about the accounting equation. And the accounting equation is your assets equals your liabilities plus your equity. And your equity is the value of what you own in the business. Okay. So assets equal liabilities plus owner's equity. And that's called the accounting equation. I'm going to show you one more example. And I just need to scooch over here a little bit. Balance sheet. There we go. And here is a sample of Ann's balance sheet. And you notice on this one, what we did, oops, a little bit too much. There we go. What we did was we showed you a 3-year comparison. So for Ann, her assets at the end of year 1 She had $29,044 in cash. She had 3,600 and change in receivables. And that's good news because you notice, if you remember, when we looked at the cash flow statement, she had a lot of money tied up in receivables. She was able to bring that down by the end of the year. She had 40,000 in current inventory. And then the prepaid expenses were expenses that she paid up front when she started the business. And you notice each year she's paying less and less on that because she doesn't need to. She's established credit with her own vendors, and because of her positive cash flow, she didn't have to prepay a bunch of different expenses. And then other initial costs. This comes from her startup of her business, and basically this is the amortization of her startup costs. So for 2020, you notice her current assets were $84,340. In 2021, the assets grew to 173,000 and change. And in 2023, her assets, or 2022, her assets more than doubled to 338,000 and change. So that was really good for her. And that was mostly, if you notice, because she was getting a lot of cash. And so that was really good. Her fixed assets, now, the value of her land doesn't change. Land is not depreciable. She can't do that, okay? Her buildings have not depreciated. The value of her equipment hasn't changed. Her furniture and fixtures, her vehicles. Now, under most circumstances, these numbers would decrease in year 2 and year 3 and year 4 and year 5. We're just doing this as an example, okay? So her total fixed assets are $125,000. But you notice we did throw in some accumulated depreciation. So her total assets have gone from 201,861 up to 440,000 in year 3. So her assets have grown. Let's see what that did to her liabilities and her equity. So her liabilities, accounts payable, has not grown considerably over the 3 years, and that's because she's had money to pay in. Her commercial loan balance has decreased because she's been able to pay her loan off a little bit. Her mortgage on the property that she bought has gone down because she's been able to pay in a little bit. She's been making money. Her credit card balance has gone down because she's been able to pay down her credit card. Her vehicle loan balance has gone down because she's been able to pay down that loan. And then her line of credit balance, she's chosen to keep that the same. And it may be the reason why she hasn't paid that down is her commercial loan and her commercial mortgage and her car loan and her credit card debt may actually be at a higher interest rate. So she's willing to pay the interest on the line of credit, but pay down the other loans. And then once they get to a certain point, it'll make sense for her to start paying down her line of credit. That is probably the reason why that line of credit has stayed the same. And so what's happened to it now? Okay, she has in 2020, $155,483 in total liabilities. She has 201,861 in total assets. So the difference in that is 46,378, which means she is in balance because her total equities and liability is the same 201,861 as you see up here in total assets. And it's the same thing for 2021 and 2022. Now, if her equity was zero or less, or her total liabilities were greater than her total assets, that's called bankruptcy. She has no way to pay off her liabilities. And that's why when you see information about, well, this company has gone bankrupt or this company is filing for Chapter 11 reorganization. Normally, under Chapter 11 reorganization, they have enough assets to keep the business open, but not enough to sustain the business. To buy additional inventory or whatever else is needed. In some cases, you'll hear about Chapter 7 bankruptcy, and that means they're going to just completely liquidate. They do not have enough assets to pay off all their debt, and owner's equity is negative balance. Okay, we are going to move right back into our slide presentation. And again, you'll be able to ask questions in a couple of minutes. Okay. What is financial modeling? A financial model is a tool that represents your business idea with numbers. It helps you examine the feasibility of your numbers and evaluate variable factors, a basis for your tracking progress, which is really important to you, and a blueprint you can adjust over time to achieve your financial goals. The worksheets that I was showing you actually come directly out of the SCORE financial modeling tool. And if you want a copy of that tool, the best way to do it is to work with a SCORE mentor to help you with that. And the SCORE mentor will give you a copy of it. You'll develop your first financial model with the SCORE mentor, and then you can use that tool as an ongoing tool for your own business where you might not need a SCORE mentor to help you because you will understand how to use the tool. Okay, what are the steps to building a financial model? First, identify the fixed assets, the operating capital that you need, and your sources of funding. How are you going to put all this together? How are you going to pay for it to get the business going, or to refinance the business, or to keep the business going, sustaining it? You're going to forecast your sales for the products or services to be sold, along with the units of sales. In other words, the units of sales is what are you going to sell? You're going to sell a dress. Are you going to do some maybe home services, home healthcare services? So what would a unit of sales be for your home healthcare business? You need to define that. And then you're going to define, well, how much are you going to charge? And then you need to understand what the cost is to produce that unit of sales. And then you're going to identify your staffing requirements. And then forecast if you allow customers to have credit or not. Again, we recommend that you minimize or do not allow anyone to use you as a credit card, and then identify what your other operating costs are. Your advertising, your professional services, any vehicle expenses, any licenses that you have to obtain, your insurance costs. All that are your other operating expenses, and you need to forecast what those are as well. And then putting that all together, what are your fixed assets? Well, your fixed assets are your buildings, your land, your equipment, your furniture and fixtures, your vehicles, and anything else that will last more than 1 year. And we briefly mentioned that before. Your operating capital includes your pre-opening costs plus operating capital to sustain the business for a minimum of 3 months after the business opens. I can tell you that in some of the businesses that I've opened, they've been very, very capital intensive to the point where we have told the lenders and the investors that we need a minimum of 1.5 years of operating capital before we're going to turn a sufficient profit to sustain the business. when you have very large businesses. The businesses that I have been involved with, one, the initial capitalization was relatively small, and in 3 years, it grew to a capitalization of about $200 million. And the problem was we were growing so fast that even though we were making a lot of money, it wasn't enough to help us with the growth. And the demand was there, the growth was there, and so we needed operating capital up front to maintain our ability to grow the company. And so, depending on your company and what your plan is, you may need more than 3 months of operating capital at the start. And then identify what your sources of funding are. Normally, you're going to be required to put in some money. And then, and that's your equity, your initial equity in the business. And then any loans, lines of credit, investments, or, capital from investors that are going to be needed. So you're going to need to define that. And that will all go in. All of this will actually go into an opening balance sheet. And that's the balance sheet that you're going to have when you actually start to work on the business. And then you're going to forecast your sales. You're going to identify each item you're going to sell or the service to be sold. Are you selling dresses? Are you selling widgets? Are you selling, are you a restaurant and you're selling food? What are you actually selling? And so you're going to identify what each one of those is, and then you're going to determine your cost of producing the product. This is usually 25 to 50% of the sales price. Now, maybe you're buying products from somebody else and just reselling it. Well, that is determined, or that is included in your cost of goods sold. Determine the sales price for each product or service you provide, and you're going to determine that by looking at your cost of goods sold and your labor, your total expenses, and saying, how do I make a profit out of this? I can make a profit if I add on 20% or 30% or 50% of the cost of the product or the service that I'm selling. In the restaurant business, which is something I'm familiar with, normally what happens is we have 25 to 30% in cost of goods sold. So a dinner, for example, 25 to 30% in the food cost and the direct labor involved in that. And then the miscellaneous labor, which might be the kitchen staff, for example, or the manager's salary. That's normally another 25 to 30%. And so we have somewhere between 40 and 50% gross margin to go ahead and pay the rest of our bills. And then forecast the quantity of sales for each product. This is going to be the most difficult to forecast the quantity of sales. And the best way to do this is to just determine what you need in order to make a profit. One other notice on profitability. A lot of businesses do not make a profit in the first 3 months, in the first 4 months, in the 6 months. Lenders and investors who know what your business is all about will not get upset about that. Okay, if you're not making money in the first year or in the second year, then they're going to have some serious questions for you. But in the first year, it is not at all uncommon because you're just building a customer base. And so don't get overly worried about that for the first 2 or 3 or 4 months or 6 months, depending on the nature of your business. I can tell you in hotels, and again, that's a business that I'm very familiar with. Even though we would run good occupancy, again, because it was so capital intensive, it was not at all uncommon for us not to make money in our first operating year. But we were honest about it. We told our lenders and our investors about it up front. They understood it and they were willing to work with us. Okay, and then you're going to forecast your labor. What kind of labor do you need? Identify what you're going to pay yourself, and that's really important. Do not exclude yourself from your pay, determining your payroll. Identify how many full-time employees you need to, and set up a schedule. Actually, do a labor schedule for each day of the week that you're open. If you're a retail business, maybe you're open 1 or 2 nights a week into the evening. You need to determine whether you're opening at 8 o'clock in the morning or 9 o'clock in the morning or 7 o'clock in the morning, depending on what you want, and actually determine a labor schedule and then run that by the number of people that you're going to need to make sure that you don't have a situation where only one person is available if that is the nature of your business. So in other words, if you're doing a service business and you only need one person answering the phone, then that's fine because the other team is out servicing your clients. So that's all right. But if you're running a bricks and mortar store, you want to make sure that there's always somebody in the store that can help your guests, your customers. Identify how many part-time employees you need. Part-time employees can fill in for full-time employees, or you may choose to have almost no full-time employees and just have only part-time employees. And that's workable as well, but you have to have a pretty good schedule because if you're scheduling a part-time or full-time employee and they don't come in, you could end up with a situation where you're understaffed and you could lose business because of that. And then finally, identify any contractors, third-party workers that your business will require, okay? And what their hourly pay will be. Now, I want to go into this for just a second. What is an independent contractor? Be very careful in identifying what an independent or contract employee is, okay? The IRS and the state of Ohio have very strict rules about workers who receive 1099 tax forms instead of W-2 tax forms. According to the IRS, people who are self-employed are considered independent or contract workers. However, whether someone is an independent contractor or a company employee depends on facts in each case. Excuse me. The general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not what is to be done or how it is to be done. Okay, and that's really, really important. So so let me give you an example. Okay, you hire somebody to work for you on a short-term basis, and they are a commissionable person. A commissionable person would be a 1099. Okay, unless they are also earning a salary. But let's say they're 100% commission. They could be considered an independent contractor. My wife works for a company right now that has about 20 salesmen around the country. And those 20 salesmen represent not only the products that my wife's company sells, but probably anywhere between 3 and 5 additional different product lines from other manufacturers. Okay, so they are independent, they are working for themselves. And when it gets to only the result of the work, and that's what's really important, is the company that my wife works for gives each one of these independent salespeople a sales quota that they have to hit. And if they achieve that sales quota, their contract is extended. If they do not achieve their sales quota, the company has the right to terminate them as a commissionable salesperson and find somebody else. And that's the best example I can give you of that. I had a client recently who started a business, ended up with about 20 people working for them. He was treating them all as contract employees, 1099s, and it did not meet the definition that you see here because he was determining what would be done and how it would be how it would be done. And so what happened was when we started working with him, when I and another SCORE mentor started working with him, we told him he was in violation of the IRS rules for contract employees, 1099 recipients, and we got him in touch with a labor lawyer. It affects not only federal and state income taxes, which contractor employees are responsible for paying themselves, but also workman's compensation and state workman's comp. And so that's really, really important. Keep in mind the earnings of a person who is working as an independent contractor are subject to self-employment taxes. To find out more about your tax obligation, visit the Self-Employed Individuals Tax Center, which is on the state and the federal income tax site. Okay. Finally, forecast the other operating expenses after the cost of producing the product or service for the cost of labor. These include advertising, vehicle operations, credit card fees. We've talked about most of these already. At this point, Anita, are there any questions sitting out there?
No, none so far.
Okay, then let's keep going. Okay, let's talk about key financial metrics. The first one is the break-even point, and I'm going to show you an example of how to determine your break-even point in just a moment. The point at which the gross margin you are taking in, remember that's your sales minus your cost of sales, is sufficient to cover the fixed expenses of running the business. So in other words, what we're saying here is that you have just enough money coming in to pay for all your expenses. And then there are a whole series of financial ratios. We're not going to go into most of those for your industry. And you can find the financial ratios that work well with your industry through the Risk Management Association and Dun & Bradstreet. They both publish this information in one form or another. And they have websites. Now, both of these are subscription sites. You have to pay to use them. But let me tell you a little secret. The Cleveland Public Library already has subscriptions to both of these. And so what I do is I tell my clients, if you want to know what typical industry operating ratios and industry benchmarking looks like, go to the Cleveland Public Library and use their subscription. Their business librarians will actually help you get into each one of these websites, and you can all you need to do is just put in the NAICS code, the North American Industry Code for your type of business, and both RMA and DMB will give you just terrific operating statistics on what your business can be, or the industry averages, average ratios for your business, and it's by NAICS code, North American Industry Classification System. And if you don't know what your NAICS code is, your accountant will probably know, or again, the business librarian at the Cleveland Public Library will help you determine what your NAICS code will be, and then you can pick this up from RMA and DMB. But let's go back and talk about the gross profit margin just again one more time. What is it? It's sales minus your direct costs. So that would be the cost of producing the service or the product that you're selling. It requires you to cost out what you're selling, helps you to determine the adequacy of your selling price. In other words, are you making enough money in your gross margin to pay for all your fixed expenses and your interest on your loan and your credit card fees, and maybe pay back some of the loan? That's um, why it's so important. And then it determines if you're going to make a profit or not. So here's an example of the break-even analysis. Break-even is where your gross profit margin equals your total expenses, or zero profit, but no loss. So you have no profit and no loss. So here's an example. Your break-even sales is equal to your fixed cost divided by your gross margin percentage. So here's an example. The gross margin percentage of sales, your gross margin is $151,300. Your total sales is $347,000. So that means your gross margin as a percentage of sales is 43.6%. Now, your payroll is 94,000 and change. Your operating expenses are 71,000 and change. If you add those two up, okay, and I eliminated the cents here, it's 165,800 or $165,082. Okay, so those are the fixed costs that you're dealing with, and so your gross margin is 43.6%. Your total fixed cost, $165,082. And so what that means is if you divide the $165,082 by 43.6%, in other words, 0.436, okay, it comes out to you have to make $378,608 in your business just to break even. If you divide that by 12, that means that on average, you have to make $31,551 in average revenue to pay your bills every month to break even. This is really important, and it's one of the key operating formulas that you need to know. Your SCORE volunteer can help you with that. If there's any confusion, again, the formula is gross profit margin equals the total expenses, okay, or zero profit, and your break-even formula is your fixed cost divided by your gross, and that's expressed in dollars, divided by your gross margin percentage. Okay, we're almost done. The importance of financial planning, we talked about that. You don't know if you've achieved a goal unless you have a plan to get there and you've thoroughly defined your goals on what you want to achieve. Understanding financial versus managerial accounting. Financial accounting is your backwards look. Managerial accounting is your forwards look. Understanding financial information. What is your gross profit margin? What's included in your income statement, your cash flow statement, your balance sheet, and then understanding your industry's diagnostic metrics. Okay, and then finally, creating a financial plan. And again, keep in mind that your financial plan needs to be an ongoing plan. In every business I've been in, we have done a 3-year rolling financial plan. So right now we're in November of 2024. That means that I would have done a financial plan for 2025, financial plan for 26, and a financial plan for 27. And then the most important of those is obviously 2025 because it's the closest. My business is going to be just going into 2025. And um, uh, then I look at that financial plan on a monthly basis. You're actually going to do it on a month-by-month basis. And I'm going to then take my financial accounting and compare my actual January results and my actual February results, my actual March results with what I actually achieve in January and February and March of 2025. Okay. And if I need to make any adjustments, maybe things are going better than I anticipated, and I'm going to adjust up for April, May, and June and the rest of the year. Or maybe things weren't going as well, and I'm going to adjust down to make sure that I at least have a path to get me to a successful end. Any questions before we finish?
I don't see any so far, no. So maybe there's just too much information. There's a lot there. Well, this will be posted on our website by the end of the week. But you will also get a copy of the slides and a link to the recording. And yes, we just have a comment. This is a lot. Also, you will be getting a survey, as I mentioned, and we would be very grateful if you would respond and let us know how you feel the webinar responded to your needs as a small business owner. So please take a little bit of time and answer that survey. So if there's nothing else, Richard, thank you so much. I've sat through this several times, and every time I do, I learn something more. So it's been very beneficial for me as well as for our clients. So
Thank you to everybody for attending. If you need more help, just sign up for a SCORE volunteer. We have 90 volunteers in our chapter that'll be more than happy to help you. And again, if we don't have the expertise we need within our chapter, we can reach out to all the chapters in the country to find somebody that can help you.
absolutely. So enjoy the rest of your day. And as Richard says, thank you for attending. The next session will